And the buzz is that Apple may seek a buyback of its shares.
Year-on-year decline in sales across those categories, apart from services.
Would you believe it if we said that the trillion-dollar company has already invested its $576 billion in this for the last 10 years? Can you guess what it could be? Not even the wildest thoughts would have not predicted this. So without further ado, let's get started. Apple spent about $7 billion on R&D each quarter. So while this amounts to approximately $250 billion over a 10-year period, that is less than half the cost of the other investment. Perhaps they used it to make acquisitions? Well, Apple has only made $2 billion in acquisitions. Beats and Intel's smartphone modern business. So not even close to $573 billion. Maybe they've been hoarding a lot of money? Apple has constantly reduced its cash reserves from above $100 billion to a little more than $50 billion. So perhaps it's the overall value of Apple's assets. While Apple's assets are remarkable at $350 billion, they still fall short of $200 billion. But if Apple didn't spend this money on R&D or investments, where in the world did it all go? Turns out that Apple's biggest bet over the last decade has been stock buybacks. You heard that correctly. Apple has spent $573 billion on stock buybacks over the past 10 years. In second position is Microsoft, which has spent $170 billion over the past 10 years, or more than $400 billion less. It appears that the discrepancy will further widen as Apple merely doubles down. In fact, Apple currently spends roughly $100 billion each year on stock buybacks. If this trend continues, Apple will spend more than $1 trillion on stock buybacks over the next 10 years. This has aroused speculation about whether Apple is attempting to go private. More importantly, it has generated questions about whether this is good for the economy. Rather than investing this money in new goods, new employment, or just keeping it in cash or bonds that can be leased out, Apple has elected to spend $500 billion boosting its stock price. So here's how a once forbidden practice grew so popular and why corporations spend trillions of dollars on buybacks every year. It is not difficult to understand why firms enjoy stock buybacks. Companies that purchase market shares and burn them not only create demand in the market, but they also reduce supply. This dynamic causes stock prices to rise. Buybacks increase the benefits of being a shareholder in addition to increasing the stock price. So it's no surprise that corporations and shareholders enjoy stock buybacks. But the economic impact of buybacks is mixed. Companies purchasing back their own stock, is not a novel concept. When firms run out of external areas to invest in, it's only logical for them to resort to investing in themselves. However, the roots of buybacks, rather than being in times of prosperity, can be traced back to the Great Depression. Many activists who opposed the stock buybacks argue that they are what caused the Great Depression in the first place. Given the economic environment, most corporations were unable to do so, but they were able to provide some relief to investors through stock buybacks. While this did not change the fact that most investors were down significantly, it did ensure that they could maximize the money that they still did have. So during the depths of the Great Depression, buybacks quickly became the go-to solution for pleasing shareholders, but this was disastrous for the economy. To get out of the Great Depression, America needed firms to invest in people, industries, and R&D. Companies, on the other hand, were wasting their limited resources on meaningless ventures. This continued for a few years until the Securities Act of 1933 and the Securities Exchange Act of 1934 were passed. This legislation was not intended to expressly target stock buybacks. In fact, it makes no mention of buybacks at all. Rather, it was intended to prevent the depression from occurring again by instituting certain checks and balances. One of these checks and balances was the prohibition of firms manipulating their own stock price. There was no discussion of stock buybacks, so there was a bit of a gray area. As a result, the practice of stock buybacks just vanished. In the 1970s, several factors contributed to the inflation spiraling out of control, the stock market stagnating, and interest rates soaring to a painful 19%. People were more than enthusiastic when President Ronald Reagan stepped in and proposed doubling down on capitalism. The theory was that capitalism was what saved America from the Great Depression and elevated it to to a world power status. So to get back on track, we should let capitalism work its magic. With that, Reagan enacted a wave of pro-capitalism legislation that would later become known as Reagonomics. This included items like lowering personal income tax from 70% to 28%, lowering corporate tax from 48% to 34%, and significantly simplifying regulation. These restrictions restricted when and how firms could purchase back stock, although following these rules is entirely discretionary. As previously stated, the SEC never outright prohibited stock buybacks. Companies could still try to test the boundaries and buy back stock without adhering to these requirements. Today, most companies and CEOs exist solely to serve shareholders as well as possible, so stock buybacks became increasingly appealing. But no firm could afford to spend tens, if not hundreds of billions on stock buybacks until Apple, or more precisely, the iPhone. Apple, on the other hand, did not immediately turn to stock buybacks. They had a lot of expenses over the first 5 years after the iPhone's release in terms of increasing production, marketing, and R&D. However, by 2013, Apple had acquired a rather strong financial position, allowing them to conduct their first stock buybacks. Apple was no shrinking violet either. They did not begin with a little buyback of $1 or $2 billion. They went straight for a $10 billion stock purchase in 2012, and less than a year later, they announced a $60 billion stock buyback. And that was the end of it from then on. Apple has been the undisputed king of stock buybacks, investing tens of billions of dollars into buybacks every year. All of this begs the question, is Apple attempting to go private? And if so, is this possibly possible? With Apple's market cap ballooning to $2 to $3 trillion, it's becoming less and less realistic, but it was very much possible in the late 2010s. In reality, Apple announced in 2017 that it planned to repurchase 50% of its stock by 2020. Going private was not out of the question, but it was never part of the plan. As a result, the shares that Apple are repurchasing are effectively being donated to all of the shareholders in proportion to their holdings. Having said that, despite purchasing hundreds of billions of dollars in stock, Apple is not going private. People frequently criticize stock buybacks, but the reality is that they are only the tip of the iceberg. The larger underlying tendency is that corporations' fundamental mission is changing. Originally, the goal of companies was to produce value in the market while making reasonable profit. However, companies' only mission nowadays is to benefit shareholders at any cost. Stock buybacks are one example of this tendency, but they are far from the only one. In 1965, the average CEO was paid 20 times more than the average worker. The average CEO today earns 399 times the average worker in the same company. So, as long as this ratio rises, you can expect that Apple and other companies will continue to gamble large on stock buybacks. Have you realized how much Apple spends on stock buybacks? Do let us know your thoughts in the comment section down below.